Hello and welcome to the Certified Equity Professional Exam Overview webinar for Level 1. This segment of the webinar is focusing on accounting. Webinars provided to assist you in your exam preparation process. This Level 1 webinar is being conducted by Barbara Baksha, CEP, who's the Executive Director of the National Association of Stock Plan Professionals. And so on Level 1, 12% of your exam is going to be accounting questions, and it's at a very high level on this level of the exam. You'll get into much more depth on accounting in Level 2 and Level 3. You may see a few more than 12 questions on the exam that are about accounting. You'll have a 110 question exam. 10 of those questions are what we call experimental items. They're items that we are trying to gather statistics on, but that are not scored. So only 12 of the accounting items that you see will count toward whether you pass the exam, but you may see 13 or 14 accounting questions overall. And on that note, I will pass it over to you, Barbara.
Great. Thanks, Pam. Okay, so what I'm going to be doing today is just giving an overview of accounting for stock compensation geared towards a Level 1 candidate. So my first slide up here talks about how we get accounting standards here in the United States. And really the main promulgator of accounting standards is the second bullet point here, the Financial Accounting Standards Board, or FASB as it's known to its friend. FASB is a private, not-for-profit organization, and their primary purpose, really their only purpose, is to develop accounting standards in the United States. They get their authority to develop those standards from the SEC. So the SEC regulates public companies, and one of the things that the SEC requires of public companies is that they publish financial statements, and that when they are preparing those financial statements, they prepare them according to a set of consistent standards so that everybody's calculating their earnings and their revenue and their profits and their expenses. Everyone's calculating all of those the same way, so that when you compare one company to another company, you're looking at sort of apples to apples. You don't have one company calculating its earnings one way and another one using another way, both trying to inflate their earnings. And ditto, as you're comparing from year to year, companies have to calculate their earnings in a consistent way from one financial period to the next, so that if you're comparing this year to last year's financial periods, everyone is using the same rules and the same calculations. That way the numbers are comparable, and you can really see whether or not a company is increasing or decreasing earnings versus just calculating their earnings in a different way that makes them look better. Now, the SEC is made up of a bunch of attorneys, and as attorneys, they don't actually know a whole lot about accounting. So I think early on, the SEC decided that it would be better to just find a group of accountants and assign them the task of coming up with what the accounting principles are that companies should follow. Initially, that was the Accounting Principles Board, but then in 1972, the Accounting Principles Board was replaced by the entity that we have now, which is the Financial Accounting Standards Board. And what the FASB does is they develop what we call GAAP, Generally Accepted Accounting Principles. At this time, there's really two forms, really just one. There's accounting standard codification topics. So all of the accounting principles we follow are sort of rolled up into one giant compendium of GAAP, and that's the accounting standards codification. It's now online. You can subscribe to it, and you can go to the website and look up really anything you want about accounting. It's all right there. Occasionally, those accounting standards have to be updated, and that's when the FASB would issue something called an ASU, which is an Accounting Standards Update. And that is just a direction on how the codification itself should be changed for new developments or changes in thought as to how things should be accounted for. In addition to FASB here in the US, there's also an international entity that does the same thing, but on an international basis, and that's the IASB, or the International Accounting Standards. What they publish is IFRS, International Financial Reporting Standards. Now, an idea behind the IASB is that not only should you be able to look at a company in the US and compare their financial statements to other companies in the US and be comparing apples to apples, but you should be able to do that for any company in the world. So you should be able to take that US company and compare them to a company in the UK or a company in France or a company in China, and everybody's using the same set of standards to calculate their financials. And until we had the IASB, every country had its own financial standard setters, and every country came up with their own rules about accounting, and some of those rules would be very different from the rules in other countries. And so it was hard to compare a company in one country to a company in another country. One thing to understand about the IASB is that they don't actually have any authority to impose accounting standards on anybody. They're made up of member countries, and the member countries have a representative on the IASB, and then together the IASB will come up with a standard. But before that standard applies to anyone, it has to be adopted in each country. So before IASB would apply to US companies, the US would have to choose to adopt IASB. And at this time, the US has not chosen to do that. We are still under our own system, which is GAAP, developed by the FASB. There are some countries that have adopted IFRS or the IASB standards, but not here in the US. So one thing I want to make clear on before we get too far into this is that what we are talking about today is compensation expense. And that is very different than compensation income, which is an amount that the employee pays tax on for tax purposes. So compensation income is whatever the taxable income the employee recognizes. I'm sure there's a separate webinar for that portion of the exam. And compensation income is reported on the company or on the employee's Form W-2, and the company gets a tax deduction for it. That's not what we're talking about today. What we're talking about is expense. And expense is something that the company reports in its financial statement. It's specifically reported in the income statement, or you sometimes hear that referred to as the P&L statement. And the idea with compensation expense is to measure what the arrangement actually costs to the company. And that's kind of challenging to do with stock. With cash, it's easy. If I pay someone a salary of, say, $50,000, it's pretty easy to know what my cost is. It's going to be $50,000. But if I pay someone $5,000 or 5,000 shares of stock, or if I give them an option to purchase 5,000 shares, well, what's my cost for that? That's a lot harder to figure out. Did it cost me anything? Because I probably wasn't going to give those shares to anybody else. Like, it's not like I was going to sell them on the open market. So did it really even cost me anything? And what if I grant an employee an option to purchase 5,000 shares, and the option ends up underwater and the employee never even exercises it? So I never even end up issuing the shares. Did that cost me anything? It's much harder to quantify the cost to the company of issuing those shares than it is to quantify the cost of cash-based stock compensation. And so that's really what we're going to be talking about today, is how do we quantify that cost, and how do we record it in the company's financial statements. And I think the important takeaway here is to understand is that that cost is determined by FASB, whereas compensation income that the employee pays tax on, that's determined by Congress, and it's determined by the IRS. And these two entities have different goals and different objectives. So the way they arrive at those two amounts is very different. And the expense that the company is going to recognize in its P&L is very, very different than the income the employee pays tax on, and even the tax deduction the company gets for the award. So we have two main accounting standards that tell us how we need to account for stock compensation, or how we need to determine that cost. Here in the US, the main accounting standard that we're using is ASC 718. That's Accounting Standard Codification 718. And then internationally, we have IFRS 2. Most companies in the US are just under ASC 718, because here in the US, we haven't adopted IFRS. But companies outside the US are largely using IFRS 2. And then there are a whole group of companies, multinational companies, that have to use both. They have to use ASC 718 here in the US, but then for any of their foreign subsidiaries that are located outside the US, they have to use IFRS 2, and oftentimes they have to reconcile those two standards. Pretty much everything that we're going to talk about today is ASC 718. IFRS 2 is probably a topic for the level 2 or the level 3 exam. For level 1, we're really only focused on ASC 718. So the first thing, if we're going to try to figure out how much an arrangement costs a company, the first thing we have to do is determine when the measurement date is. And the measurement date is just an arbitrary point in time where we're going to basically put a stake in the ground and say, on this day, we are going to determine the cost. And that's going to be our cost going forward. It's going to be, no matter what happens to our stock price, once we have our measurement date, that's our cost. There are two types of stock awards. There's equity awards and there's liability awards. And the difference between the two of these is largely how they're paid out. Equity awards are generally paid out in stock, and liability awards are generally paid out in cash. For equity awards, our measurement date is usually going to be the date of grant. And under ASC 718, that's specifically defined as the date the terms of the arrangement are mutually understood. So that means, first of all, the grant has to be approved. All of the required approvals to issue that grant have to have been attained. So the board has to approve the grant, and shareholders have to have approved the plan under which the grant is made. The price that the employee has to pay for the stock has to be set. That's a key term. Everybody has to know what that price is going to be. And then all the other key terms of the arrangement have to be understood, so by both the company and the employee. So we largely have to have communicated the grant to employees, or be planning to communicate it within a relatively short period of time in order to have in order for our grant date to be our measurement date. For liability awards, in that case, because we're paying out the award in cash, generally anytime you are paying out compensation in cash, the amount of cash that you're going to pay out is going to be your expense. And with a liability award, we won't actually know how much that cash is going to be until we get to the settlement date. So that's usually the payout date or the exercise date or the expiration of the award. So our measurement date won't actually occur until we get to settlement and we know what our final cash payout is going to be. Until that date occurs, we'll have to estimate our expense, and we'll record expense based on those estimates until we finally are able to determine what the cash payout is.
And at this point, I'm going to put in a plug here for making sure that you've got the current editions of the books, because if you don't, you may end up thinking that there are some differences between employee and non-employee accounting that no longer exist, and we're testing on the current state of that. So make sure you've got the editions of the books that are listed in your binder.
Yeah, that's a good point, Pam. There's a big change in how non-employee awards were accounted for last year, and they're now accounted for the same way that employee awards are accounted for. So it used to be we'd have to go through a whole separate explanation of non-employee awards, and we don't have to do that anymore. But if you have an older version of the book, it may still do that, and that's no longer relevant. All right, so once we've determined our measurement date, so now we know when we're going to calculate our expense. The next step is to actually calculate what that expense is. And our expense for any equity award is going to be the fair value on the measurement date. And I want to sort of emphasize that fair value is not necessarily the same thing as fair market value. So your fair market value is generally your closing or average trading price of your stock. Whereas with fair value, we're looking at the financial instrument that we've granted to the employee, and we're trying to calculate what the value of that instrument is. If we've granted restricted stock awards or restricted stock units, if they're service-based, that's a pretty straightforward amount, because a service-based restricted stock, and by service-based, I mean the awards vest only on the passage of time. The employee just has to manage to keep their job for the length of the vesting schedule, and then the awards will vest. In that case, we've basically just given the employee stock, and that stock is eventually going to vest. And so in that case, we'll actually look to the value of the underlying stock, and that will be our fair value of the award. So for restricted stock and RSUs, our fair value is generally just fair market value on the date of grant. There is an exception to that, and that is if we've granted RSUs or restricted stock that vests based on what we call market conditions, and that's generally a condition that's based on the price of the company's stock. So it could be a stock price target, or it could be a TSR, total shareholder return target. In that case, we have to use a more complicated valuation method called a Monte Carlo simulation. For stock options, it is a little bit trickier to determine the value of that award because the employee doesn't actually get stock with a stock option. What they're doing is getting the right to buy stock. And they have the right to buy stock over, say, a 10-year time period at a price that's set today. So what we're trying to value here is what that right to buy stock in the future at a price set today is worth. And that's going to be less than if they just got the stock. If we just gave them the stock for free and they have to pay for it, that's a little bit more valuable than having the right to buy stock in the future at a price that we set today. But there's still value to having that right. And we determine that value using an option pricing model. The most common model to use is a Black-Scholes model. That's the most well-known. Option pricing models are actually really commonly used in the options trading market, and most traders are using the Black-Scholes model. There are some other types of models called lattice models. And at one point, we thought those were really going to take off and be really commonly used, but they're not that. That didn't really actually happen, and most companies today just use the Black-Scholes model to value their options. But companies can use whatever option pricing model they want, so long as the option pricing model takes into account 6 different factors. The first 2 factors that the option pricing model has to consider are the 2 hardest to figure out, the expected term and the expected volatility. Expected term is the length of time that we expect the option to be outstanding. And for employee stock options, the option's only outstanding until it's either exercised or it's canceled. So what we're really trying to predict with the expected term is when is the employee going to exercise the option, or when is the option going to cancel without being exercised? We are supposed to estimate that using the company's historical exercise behavior for similar types of options, or using peer data. There's not a whole lot of peer data available on this. At one point, the FASB thought that great databases would develop where people could just look up exercise behavior, and that just never really came to pass. So most companies really have to look towards their own history to try to estimate what their expected term is going to be. Some companies don't have any history. If you're a newly public company or if you're a private company, you may not have had any employees exercise any options, or maybe you only had a few exercises, not enough to really estimate what you think your expected term is going to be. In that case, there are a couple of different ways to do that. For private companies, they can use something called the practical expedient. I have expedience on the slide, but it should be expedient with a T on the end. And for public companies, they can use something called the simplified method. Those can only be used in certain circumstances for options that meet certain conditions. They generally have to be sort of plain vanilla options that just vest based on the passage of time. And they have a price equal to fair market value on the date of grant. But, and they're both basically, they amount to the same thing, which is to use the average of the vesting period and the expiration date of the option. And it gives the company a way to just sort of, in the absence of any other way to figure out their expected term, they can just calculate their average of between the vesting and the contractual term and use that. One thing to know about the expected term is that the longer the term is, the higher the value of the option would be. So the longer the employee waits to exercise, the more opportunity there is for appreciation to build up in the option, and that makes the option more valuable. Next up, we have expected volatility. Expected volatility is a measurement of how much the company's stock price is going to fluctuate over the life of the option. And that also should be based on a company's historical volatility or the volatility of its peer companies. The higher the volatility, the higher the value of the option. Because again, so the more volatility there is in the company's stock, the more opportunity there is for there to be great swings in the stock price and for the option to end up being wildly valuable, and that makes the option, the fair value of the option higher because the option is more valuable. Public companies will usually look at their own historical volatility. They can also look at something called implied volatility. What implied volatility is you're sort of reverse engineering what your volatility is by looking at your own exchange traded options. So if you have options traded on an exchange, you know what the value of the options is because you can see what traders are paying for those options. And you can pretty much figure out every other input into the Black-Scholes model except for volatility. So you can basically look at the value, figure out all the other inputs, and then solve backwards to figure out what the volatility was that the traders were assuming when they calculated the price they were willing to pay. And that's what's called your implied volatility. And that is another way of sort of looking at, of trying to estimate what your future volatility is going to be. For privately held companies, they're usually using their peer company volatility because they oftentimes don't have any. They have to look to their publicly held peers and use that historical volatility because as a private company, they don't really have any. Their stock just isn't volatile while they're private. All right, the next 4 variables that the option pricing model has to consider are a little bit easier to figure out. The first one is the exercise price. That's just the price the employee has to pay to exercise the option. We say here on the slide, the higher the exercise price, the lower the fair value. But really, you have to think about that as working in conjunction with the fair market value of the stock on the date of grant. So the higher your fair market value, which is the second input there on my slide, the higher your fair market value, the higher the fair value of your option is going to be, because the greater the underlying stock is worth, that just the fact that the stock is worth more means that the investors see it as having more potential, which would mean more opportunity for the employee to make money on the option. So that's going to increase the value of the option. And the exercise price sort of works in conjunction with that. The closer the exercise is to the fair market value, the lower the fair value is. And the greater the discount is between the exercise price and the fair market value on the date of grant, the higher the value is going to be. The third input here is your expected dividend yield. That would be the dividends that you expect to pay on the stock underlying the option. And here that has the opposite effect on the fair value. The higher your dividend yield, the lower your fair value is. And that is because most companies don't pay dividends on their stock options. So the fact that you pay dividends on your common stock makes holding the common stock a little bit more valuable than holding an option, because you don't get the dividends while you hold the option. So therefore, that makes the option a little bit less valuable. And then finally, the last factor here is your risk-free interest rate. This is also pretty easy to figure out. It's supposed to be the rate on I think a zero coupon government bond, but that rate's almost impossible to find. It's not reported for free anywhere. You have to subscribe to something to get it. So most companies just use treasury rates, and you would want the rate that's equal to the expected term of the option. If you think the option is going to be exercised in 5 years, you want the 5-year rate. The higher your interest rate, the higher the fair value of the option is going to be, because the option allows the employee to buy stock in the future at a price set today, but without having to actually invest their money until some point in the future. So what the model assumes is that the employee is going to be earning interest on their money during that whole time when they're waiting to exercise their options. And the more interest they can earn on that, the more valuable having the option is to them. Okay, now we've figured out our day where we're going to calculate our expense. We've calculated our expense. The third thing we have to figure out is the period over which we're going to record the expense. There's just sort of a basic principle in accounting that we recognize our expenses as they produce revenue for the company. So with compensation, we don't necessarily recognize all that expense that we calculate for an arrangement all at once on the date of grant, because presumably that, particularly in the form of equity awards, that's going to encourage our employees to work for us over time. And over that time, the work that they're performing is going to produce revenue for the company. And therefore, we should recognize the expense associated with that option over that period that the employee is performing work for us. And we're going to call that the service period of the equity award, the arrangement. It applies to both options and other types of awards. There's 3 different types of service periods that we can have for an equity award. The first is the easiest. That's the explicit service period. That's just my stated vesting period. So if I grant an award and I say it's going to vest in 4 years, I have a 4-year vesting period. It's nice and simple. Any of my awards that vest based on service or time, just passage of time, will have an explicit service period, and it's that time period over which the award is vesting. The second service period is an implicit service period. This is a service period that applies to performance awards. So if I grant an award and I say that it's going to vest when we meet this revenue target, then my implicit service period is the period over which we expect that revenue target to be met. And then the third type of service period I can have is a derived service period. And this would be for an award that vests based on a market condition, like a stock price target or total shareholder return. In that case, we can actually use an option pricing model to calculate when we think that stock price target or that total shareholder return target is going to be hit. And that would be our derived service period. And you can have a combination of different service periods. So most of my performance and my market-based awards will also have an explicit service period. Sometimes you could have awards that have all three. You could have an award that vests based on a internal metric like revenue or earnings or some sort of milestone goal, and it also vests based on a TSR target, and then it also is subject to a time-based vesting period. So in that case, you might have all three types of service periods. Once we have determined what our service period is, that's the period over which we're going to recognize our expense. Then we have to actually start recognizing expense over that time period. If I have an award that vests based, that uses cliff vesting, so this would typically be, it could be a time-based award, or it could be a performance or market condition award where there's really just one goal. So we grant the award and we say it's going to vest in 3 years. Nothing vests before 3 years. At the end of 3 years, the entire award vests, or it falls off the cliff, so to speak. For that type of award, we just use a straight line accrual. We're just going to take our expense and we're going to record it evenly over that 3-year time period. And it doesn't matter whether that 3-year time period is a explicit, an implicit, or a derived service period. We're just going to record expense evenly over that time period. Most awards these days, however, have graded vesting. So they vest in increments. We particularly see this with time-based awards. So I rarely see time-based awards that have just a cliff vesting period. I usually see that awards have maybe 3-year annual or 4-year annual vesting, sometimes 5-year annual vesting. Sometimes I see monthly vesting or quarterly vesting. So anytime we have awards vesting in increments like that, we have a choice of approaches to recording that expense. One thing that we could do is just look at the total period over which all those increments are vesting and record expense on a straight line basis over that time period. So in that approach, it's sort of the same as what we would do with cliff vesting. So if I use straight line vesting, I could have an award vesting over a 3-year annual period. So a third of the award vesting per year over 3 years. And I just take my total expense for the award and spread it out evenly over that 3-year time period. And my expense accruals would be exactly the same as if I had an award with just a 3-year cliff vesting period. And actually, we have an example on that sort of compares these two approaches. So the first one is a straight line accrual. So I have an award valued at $100,000. That's my cost for the award, and it vests in 2 annual increments. And in a straight line accrual, we're just going to take that $100,000. We're going to divide it in 2 because we have 2 years in my service period, and we're going to calculate $50,000 of expense per year. With the accelerated approach, we actually treat each vesting increment as a separate award, and we're going to accrue expense for both vesting increments simultaneously. So that's what you see in the bottom half of the slide. We have my award valued at $100,000. It's 2 vesting increments that are worth $50,000 each, and we're going to treat each of those as a separate award. So for the first vesting increment, that's an award that vests in 1 year. We're going to record all $50,000 of expense in year 1. And for the second vesting increment, that would be an award that's vesting over 2 years. We're going to take that $50,000 and divide it up over that 2-year time period, and we'll record $25,000 of expense in year 1 and $25,000 of expense in year 2. And that means that my total expense for year one is going to be $75,000 because it includes all of the expense for tranche one and a half of the expense for tranche two. And then we see a very sharp drop off in year two because we've already expensed all of the first tranche and we just have the $25,000 remaining from the second tranche that we need to record in year two. Either way, whether I use the straight line or the accelerated accrual, you can see that the total amount of expense I record is the same. It ends up being $100,000. It's just a matter of when I record that expense. And we call it the accelerated accrual because you can see that it sort of front loads that expense. We end up recognizing more of the expense in the first year. Companies can make a policy decision as to whether they want to use straight line accrual or accelerated accrual. Whatever they decide, they have to be consistent. So they have to use the same approach for all of their equity awards. And it's difficult to change your decision once you've made it. So for those of you that are working for companies that have been, that have had equity plans for a while now, maybe they already had their plans in place when you came in, this decision has already been made and you just have to keep doing what was decided in the past. If you want to change between these two approaches, that would be a change in accounting policy. You have to get a letter of preferability from your auditors stating that the method that you're changing to is more preferable for the types of equity awards that you grant. And you have to, when you make the changeover, you have to do retrospective restatement. So most companies don't want to change methods, and really it's not even feasible for most companies to change methods because it's actually fairly difficult to get that letter of preferability from your auditors. So whatever method you've been using, that's probably the method you're going to be sticking with. All right, next up, let's talk about forfeitures. Sometimes awards don't end up vesting, and what ASC 718 says is that companies shouldn't have to recognize expense for awards that end up being forfeited by the employee. Now, I want to be clear, once an award vests, that expense cannot be reversed. So if we grant an option and that option ends up falling underwater and then the employee allows it to expire unexercised, if the option vested, when it ends up expiring unexercised, we don't get to reverse any of the expense for it because it vested. The only instance where a company can reverse expense for an award is if it doesn't vest, if the employee ends up forfeiting it before the award vests. For grants that have time-based vesting, companies can choose two different approaches to account for forfeitures. One is to estimate their forfeitures up front, and rather than recording the full expense that they calculate for the award, they only record a portion of that expense based on what they expect their forfeitures to be. So if I grant a bunch of awards and I expect that 20% of my employees are going to terminate before their awards vest and they're going to forfeit their awards, rather than recording 100% of the expense that I've calculated, I'd only record 80% of it because I expect that 20% of those awards aren't going to vest anyway, and I'm never going to have to recognize that expense. The other way to account for forfeitures is to just wait till they occur. So in that, if I use this approach, when the awards vest up front, I'd start initially recording 100% of the expense that I calculated, and then as those 20% of employees actually end up terminating, at that point, I'll record an adjustment to back out any expense that I've already recorded for their awards. If I estimate forfeitures up front, that's harder to do because it requires me to try to forecast what my forfeitures are going to be, but it is supposed to make for a more even amount of expense that I'm recording from period for period. And generally, accountants don't like things to vary a lot from one period to the next. So we like our expenses to be nice and even and predictable. If I'm accounting for forfeitures as they occur, sort of the opposite. It's a lot easier to do. I don't have to do this advanced, I don't have to do this estimate of what my forfeitures are going to be, but as forfeitures occur, it may cause my expense from period to period to swing pretty significantly. I find that larger companies tend to estimate forfeitures because they have the resources to do it and they like to have their financials be as predictable as possible. And smaller companies where they just don't have the resources to estimate forfeitures will just account for forfeitures as they occur. It also probably depends on how material your stock compensation is to your overall income statement or your P&L statement. If stock compensation is a pretty large expense item in your P&L, you may want to estimate forfeitures up front. If it's not really material to your overall P&L, you're probably just going to account for forfeitures as they occur. All right, and then my last topic here is just a quick discussion of employee stock purchase plans. Employee stock purchase plans are a little bit different than our other types of equity compensation. First, in that they can be considered non-compensatory. All of my other equity compensation, so RSUs, stock appreciation rights, stock options, performance awards, all of those are all clearly compensatory. There's no circumstance in which they would not be treated as a form of compensation. But ESPPs can sometimes be considered non-compensatory. And something that's non-compensatory is it's not compensation, which means the company doesn't have to recognize any compensation expense for it. It's like it just doesn't exist for purposes of the P&L. In order for an ESPP to be non-compensatory, it has to meet 3 conditions. First of all, it can't offer a discount of greater than what the cost of raising capital is. ASC 7018 specifies a 5% safe harbor, so a discount of less than 5% can clearly be considered non-compensatory. Most companies that want to offer a non-compensatory plan try to stay within that safe harbor of 5%. If you were a little bit over 5%, you might be able to justify a higher discount if you could show that your cost of raising capital, if you were to go out with some sort of public offering, would be greater than 5% of the purchase price. But it's hard to demonstrate, and you have to demonstrate it every single time you have a purchase. And so most companies that want to have a non-compensatory plan prefer to take the easy way out and just stay within that 5% safe harbor. The second condition is that the plan can't have any sort of look back or any sort of option-like feature. A lot of ESPPs that I see calculate a price based on the lower of the beginning date, so the enrollment date fair market value and the purchase date fair market value. That's called a look back. And if you have that feature in your plan, it automatically makes it compensatory. If you want to have a non-compensatory plan, you have to be calculating your price based on the purchase date fair market value only. And then the third requirement is that you have to allow substantially all employees to participate on an equal basis. This requirement's easy. You're already doing that because you have to do it to qualify your plan under Section 423. But the first 2 requirements are a little bit harder, and if you meet those requirements, it tends to make for an ESPP that not very many employees are that interested in participating in. So we don't see a whole lot of non-compensatory ESPPs. We do see a few, but most of you that offer ESPPs are probably offering a greater than 5% discount. Most of you probably offer a 15% discount, at least according to the surveys that the NASCP does. And a lot of you also offer a look back, and that means a lot of you have ESPPs that are going to be treated as compensation, and you're going to have to record expense for them. Which brings me to my next slide. If you have an ESPP and it's considered compensatory, then essentially what you have is a stock option. On the date the employee enrolls in a plan, they are granted a stock option that they then exercise on the purchase date. And we have to calculate the fair value of that stock option and then record expense for it over the service period. So on the date the employee enrolls in the plan, we're going to calculate the fair value. Here's another place where ESPPs differ from other types of equity compensation. With an ESPP, your fair value can include up to 3 different components. The first is the amount of the discount that you offer. So if you offer a 15% discount, we're going to take 15% of the enrollment date fair market value, and that is a dollar for dollar included in your fair value. The second is the value of the look back. So if you allow people to purchase at the lower of the enrollment date or the purchase date fair market value, that sort of gives the employee the right to buy stock in the future at a price that was set today. So it's an option. It looks exactly like a stock option, and we have to use an option pricing model. Usually we would use the Black-Scholes model to calculate the value of that option, and then we'll take a proportionate value of it. So we've already included the 15% discount. If we have a 15% discount, we've already included that discount in our fair value on a dollar for dollar basis. So we would just take 85% of the value of the option, and that would be also included in our fair value. And then the last is the value of the additional shares. Unlike sort of a typical stock option where the price is based on the fair market value on the date of grant, in an ESPP, the price is based on two possible values, the value on the date of enrollment or the value on the date of purchase. And if the employee ends up purchasing, if the stock ends up declining during that purchase period and the purchase price ends up being based on the fair market value on the date of purchase, the employee is able to purchase more shares because their price is lower. They have the same amount of contributions, but a lower price, they're going to get to purchase more shares. And so our third component is we're going to use another option pricing model to calculate just the value of those additional shares that the employee might be able to purchase if the stock declines in value. And then that also gets added into our fair value. So those three components, we add them together. That would be our total fair value for the ESPP. It sounds like it's going to be really expensive because you have three components, but in actuality, because your expected term on your ESPP is just from enrollment to purchase, and that's usually a much shorter period of time than the expected term on a traditional stock option. Even with these three components, the value of your ESPP usually ends up being a lot less than the value of your stock options. Once we know that value, then we're gonna record it with an ESPP. Our service period is just going to be that purchase period or that offering period. So we'll just so for example, if I have a 6-month, a very common plan that I see is an ESPP with a 6-month offering period and a purchase only at the end of that offering period. So people are just purchasing every 6 months, and every 6 months we start a new offering. So at each offering start date, we calculate the fair value of that ESPP, and then we record the expense that we've calculated over the 6 months until the purchase occurs. And then when the next offering begins, we calculate a new fair value, and we calculate that expense over the next 6 months. Sometimes we see ESPPs that have an offering period with purchases occurring periodically throughout the offering period. For example, here in Silicon Valley where I work, we see a lot of ESPPs that have a 24-month offering period with purchases occurring every 6 months. So in that type of ESPP, on the enrollment date, so at the start of that 24-month offering period, the employees who enroll at that time, they're actually considered to be having been granted 4 options. They have one that they exercise in 6 months, one that gets exercised in 12 months, one that gets exercised in 18 months, and one that gets exercised in 24 months. And so on that initial enrollment date, we calculate the fair value of all 4 of those options. And then we would have a choice. We could either calculate the total fair value, we could either take that total fair value for all 4 of those options and record it on a straight line basis over that 24-month period, or we could treat each of those 4 options as a separate option and do the accelerated approach that I just went through a couple slides ago. And in order to calculate our total expense, we'll look at what we expect employees to contribute. We'll divide that by our purchase price on the fair market value on the date of grant, and that would give us an idea of what the total number of shares are that people are going to purchase. And then we would calculate our per share fair value by those total estimated shares, and that's our expense. And then you might think, okay, well, but if the price ends up being lower and everybody ends up purchasing more shares, do we have to go back and recalculate our expense? But we don't, because we already built that into the fair market value. Because remember, we use that option pricing model to calculate the value of those additional shares. So we've already accounted for those additional shares when we calculated the initial fair market value. So if our price declined and everybody ends up being able to purchase twice as much stock as we expected them to purchase, we don't have to make any adjustment for that because we already accounted for it. And Pam, I think that takes us to the end of our content for level 1. So that's all I've got to say. Good luck on the exam, everyone.
Yeah, thank you so much, Barbara. So a couple of disclaimers here and a little more information. So if you're interested in some additional courses that might help you with your exam preparation, we've listed a couple options on this slide. But with this disclaimer that the exam overview webinar that we've just done and the additional educational materials are not sufficient exam preparation. The exams are based on what's in the textbooks. So, and if there is anywhere that you are in doubt about the correct answer, refer to the books. That's what we look at when we're writing the questions. This webinar is available to you for unlimited viewing until the exam date, and that is also true for the webinars for all of the other subject areas at level 1. And if you are taking level 2 or level 3, you can view all of the webinars for all of the different levels. And on that note, this wraps up. Thank you all, and good luck on the test.